Let's talk just one indicator that you use for the market besides the 21-day moving average line, and that's regression channel lines. Can you describe how you use these and why you might prefer some of these over a moving average?
Yeah, I like to use them in addition to the moving averages. And let's take a look at this is the Nasdaq with my regression channel on there. And for those who are into this type of thing, I'm using a one standard deviation above and below, and I use the high plus the low divided by 2. Don't worry about all of that. This is a regression channel is just a line of best fit. It's just telling you where that trend is. And that's your white line, which is in the middle. That's your regression. That's just saying, okay, if you look between, all these dots, what is normal? What is your trend? So when I see a trend start, I put a regression on there once we get into it a few weeks, and I will stop it 50 days into it. Because if you keep on taking your regression line dates out further and further, you're looking at a bigger data set. And then that's just going to get wider and wider, and it's not really going to tell you anything.
It's going to keep on fitting to the new data, right?
By definition, right?
Yeah.
It'll be data fitting. So we're just going to take, we've got January. What were the dates that I gave you?
So November 1st, the follow through day is where you're starting. And then 50 days out is January 12th. So that's your second anchor point.
Yeah. So that's right here. So that's where we're stopping this. So these lines are based off the information between here and here.
And just real quickly to describe it again, you've got that dashed white line. That's your best fit line. You've got the red dashed line above. That's your one standard deviation above.
Yes.
And it's red because, be careful. You're getting up there. And then you've got the green solid line below. And that's, not to be confused with the moving average, the red line. That green solid line is your standard deviation below. And that's kind of where you want to potentially look at buying again, right?
Exactly. So there's a couple things going on when you're using regressions. One, you want to see, is the trend too steep to continue on for a long period of time? And you just look at this, if you've looked at charts for any period of time, you just know that you can't continue at that pace. But you never know how long. The old saying, the trend is your friend until the end when it bends. And it's that same thing here. And we're seeing that we're starting to fall out of it here recently. But so that's one thing you're looking for, is the angle of ascent. Is it too steep? And the other thing is, if once you get up to the top of the line, the top line, the red line, then you're getting a little too overheated, and you're expecting a pullback. If you come into the green line, if that trend is going to continue, that's an area where you're waiting for some strength to go back in and push it. So just kind of think of, the old buy high, sell low type of, or buy low, sell high type of thing within a trend is generally speaking what you're doing with this. But you also want to recognize when it starts breaking character. And let's also look at it on SPY. And here we're using the same dates that we had before, and this is for the S&P 500. And you can see how it was trending up, but then it started going at a little bit of a different angle. And you want to pay attention to when the character changes. And the character kind of changed around here. We'd gone sideways, and then we started moving forward again, kind of breaking.
So that was in January, mid-January that you're pointing to.
Exactly. Right? So I'm going to put a new regression channel on here.
And Mike, just quickly explain why did the character change there? It seems like explain why you were saying that the character was changing there. Just because it was starting to break out into higher highs again?
Well, what was going on? Let me just set this real quick I am using on this January 18th and then March 28th for this next 50-day period. And to me, what it looked like is you had your initial thrust from your 3 waves down, which was kind of your power from your breakout. And then it paused. You had your first initial pause of your consolidation, and it was kind of resetting itself the same way your 3 waves down, which was over in this area, 1 wave, 2 waves, 3 waves, that reset. what the market was doing. So you stopped, you paused, and the market was trying to decide, are we going to roll over or are we going to move higher? And then right here, that's when it decided it was, you know what, we're going to go up again, but I'm going to remove this, the first one, just to clean up this chart. And you can see now with this new one that was started there when I was saying that we had a character change, it's trading more in line with a more realistic angle. So that's telling you that this could, doesn't mean it will, could continue on longer than we think. We want to really pay a lot of attention to it when it gets down into the green area. If it gets overheated up to the red area, that's when you're saying, you know what, is getting too hot, almost climax action type of feel from a market standpoint, that you would want to be dialing things back. You wouldn't go to cash at that, you know, if it went up to the red line, but you would just be looking for every offensive sell signal you have on your individual stocks and trying to reduce exposure. But if you get down to your green line down here and you get a turn up, that's when you're going to want to press on the gas. You don't, if it comes crashing to that line, that's different. You want it to, you want to, as Brian Shannon likes to say, you buy the strength after the dip, or he says something along those lines, which is how I've always traded too. Instead of buying the dip, I like to buy the strength after the dip, the way he does. And so it'd be the same thing. If it comes in here and then goes up, that's where you're gassing it. When you get up closer above the white line, the regression line, closer to the red line, that's when you're saying, okay, things are a little bit too hot. I'm going to start dialing things back. So in a nutshell, you're using these to monitor the trend, see if, you know, it's staying within character, and it helps you to tune out the little daily noise that we have to see, like, did anything really break today, or was it really as strong of a day as we thought? And this really helps as far as I'm concerned.
Yeah. So this can really, you know, help you on the holding side, you know, for, yes, this is normal. But let's talk a little bit now about on the individual stocks.
Well, before we get into that, so Mike, just so for the SPYs, it's completely within character. For the Qs or the Nasdaq, it might be getting a little tired, or because it's starting to fall a little out of character below the lower regression line, right?
Yeah, it is starting to, certainly the original regression line, it's starting to, and let's just go ahead and add this.
Yeah, I was going to say, let's see what it looks like on your
so
your new regression.
Yep.
It's still within that. But it has gotten kind of to the top a few times, and to the bottom a few times.
Yeah, see, notice how nice that was right here. If you were using this, you would be saying, okay,
and that's in mid-February that you're talking about, for the first kind of touch of the red line.
Now, of course, this is with a bit of hindsight because it's using the data from here all the way out to March 28th. So you don't really know that at the time, but it helps you to know that, like, okay, is this regression line making sense? I'll put regression lines on all the time, and then I'll look at it and say, well, this doesn't make sense, so I'm not using it. So it's not like the 21-day I'm using all the time. The regression, I'm using it selectively when it makes sense.